Thank you so much for making the time to come on. So without wasting much time, I'm just going to jump right in. I am so excited. I can't wait to learn more. Every time I talk to you, I learn so much from you.
Well, thank you.
You're welcome. My first question to you is, what is life insurance? So that is the main focus for today. Can you please describe what that means or define what life insurance is, please?
So life insurance is a contract between the policy holder, which would be you or me or anyone who's buying insurance, and the insurer, which is the insurance company, where the insurer promises to pay a designated amount to the beneficiaries of the insured should something happen to them. So the insurance, the designated amount comes in different face values. We call them face value. It can be 100,000, 500, any amount that is suitable depending on what you are covering for. The insured must be paying a premium every month or every year, whatever, however they choose, for them to be able to get some money at the end. The beneficiaries get the money tax-free. So that's the main thing that we need to know, because we also talk of tax strategies when we help people with financial advising. So that's a number one benefit, that even if it's $1 million, it comes to the family tax-free.
So the beneficiary can be anyone?
The beneficiary is when someone applies for insurance, they actually get to name their own beneficiaries.
Okay.
So it can be your children, it can be your parents, depending who your loved ones are, who you would want to, normally it's people you are taking care of. Mm-hmm. So this money is paid for them to continue with the same kind of life they had even before someone passes away, because people will be mourning for the person who is left, but then they want to be confident that we are mourning, but we are still taken okay.
A lot of times, I know with our community people, people think, oh, okay, if I get insurance, it means it's time for you to pass away. So a lot of people don't want to hear it. But why should anyone need insurance? Why should we get insurance?
Like I was saying when I was explaining to you what I focus on, savings, debt, and insurance, I said insurance is the last one by design. Why? Because it's the foundation for any financial planning. So the insurance is the foundation for a good financial background. Everyone should be, just like building a house, you need a good foundation, and then starting from the ground going up. And many families, they start without a lot of money. Rarely that's what we are teaching people now, that we need to build intergenerational wealth. But for me, you, Abby, and many other people online, we started with nothing. So when in a situation like that, you are young, what do you need? The first thing you need, some people think, oh, I need to open a savings account, which is good for emergencies. But if you're going to be buying a house, paying those student loans, paying for that car, paying for a car, and if should something happens to one of the spouses, let's say both are working, and then what will happen if one goes when there's no insurance? You've gone in a mortgage, you have a new car, you have student loans, you still have to plan for children's education funds. What will happen to that family if there's no insurance? Because insurance comes in a lump sum, like $500,000, 800,000, 700,000. And then the second level is middle-aged people. They might have done everything correctly, bought their house, paid their bills, in the process of finishing off their student loans, and then, God forbid, they get diagnosed with critical illness, or they get injured in a car accident. And if there's no insurance, they'll start dipping in those savings. But if there's insurance always replaces the income. And then the last life stage of retirement, where insurance is really important, is people like the COVID came, and someone who turned 65 this year, imagine what happened to them. Their investments went down. Maybe they didn't have good advice on the investments, and they didn't have insurance, and now they have to go and start looking for a job. And then, God forbid, if they die, what is going to become of their family? They still have debt at 65. They didn't have money even to be buried for burial. So insurance is always important, is an important piece of your financial planning process, so that it will always be there to replace income lost however way. So insurance will always be needed to replace the income.
Wow. I see so many benefits. Insurance is there to replace an income. There's planning against premature death, creating an intergenerational wealth. How do you convince someone who doesn't buy into all these benefits to get a life insurance?
I don't really convince them as such, but I educate them.
Okay.
I'm a financial professional. I'm a financial literacy coach.
Mm-hmm.
So many people, it's not like they don't want, but they don't understand why they need it.
Okay.
But if you educate them, and then they know why, and you show them the gap. If you do their financial plan, like what I said before, I cannot just come to you up and say, I need to sell you insurance. I will say, I need to give you a financial checkup.
Mm-hmm.
Checkup. I'm going to, just like a medical checkup, you always go, even when you are not sick, you go to a doctor every year. Financial checkup, we'll be checking whether your investments are growing harder for you. I talked about savings. We'll be checking whether your debt is appropriate, because sometimes you have 6 credit cards that you don't need. The rule of thumb is every person needs at least 10 to 20% of annual income for insurance coverage, because the whole idea is not for you to be over-insured, but the whole idea is to insure you enough so that you'll be able to pay your debt. If someone passes away, we want the debt paid off. Someone passes away, we want the children to have money for school, be it they invested already or be invested from the payout for the insurance policy. If it's a spouse left, we want them to continue living in the same house. We want them to continue having the same kind of life. They will be mourning, but at least they are comfortable. So it's not a matter of convincing someone, it's a matter of showing them why and filling in the gaps in their financial planning.
Like, I know you have mentioned a couple of benefits to add to what you have already mentioned.
Sure. Life insurance, it provides cash, like I said, tax-free. Mm-hmm. And then when money is growing in insurance, because there are 2 types of insurance, I'll show you later in a slide.
Okay.
Sometimes it's a term insurance where we call it, it's term, so it's temporary insurance for paying debt, student loans, credit cards, all that. But then we encourage people to be in an insurance where they'll get something at the end, because term insurance for your beneficiary when you pass away, and then you can also exchange it for other insurance policies. If it's a term insurance, you can convert it to a universal later on when you can afford, because it's not like someone has to start with that insurance with savings, because maybe they don't, if their cash flow doesn't allow that, but you can start with a kind of insurance and then convert it to another type, which will benefit you in the future.
Are insurance for everyone? Like, should everyone be looking at insurance, such as children, or do you have to wait until you're a certain age? Like, what advice would you give to someone who thinks, oh, I'm only 25, I don't need a life insurance?
I've heard that a lot. But you know what, Abby, no matter how young you are, you if you have loved ones, you can get insurance when you're 18. You can get insurance. You may not have started a family of your own, but let's take for instance, someone 21-year-old who's graduating from university with a lot of debt, and they might be in a program where they need more money and their parents had to co-sign for their debt at the bank. So should someone happens to that young lady or young gentleman, their family is left with a lot of debt they had not planned for because they co-signed. So we always want to recommend that if you have any kind of debt, you need to get an insurance. It doesn't have to be big, but it has to be something that will be able to pay off your debt should something happens to you. Because if it's $500,000 divided among the family, they will remember you for that. Because some people don't plan for burial costs, like you said earlier, in our culture, not in our culture, many people, they don't like to plan for funerals. It's only now when I see people are beginning to kind of warm up to that, but they don't really, people are not really keen on planning for funerals. So insurance will cover everything, pay your debt, your final costs, but you don't have to be just have to be above 18 to sign up for a contract.
Wow. Some people will say, oh, I think I should save my money. because I think I'm younger. I don't need insurance now. Let me save this money. Is it better to save your money than to think of getting a life insurance?
You know what? It's a question that I cannot really say you can't or you can, but for the most part, it depends. Now, where are you saving? Where will the money grow harder for you to beat that tax, all those taxes, and then to grow such that you can build, let's say, $1 million behind that savings? That's the first question you need to know. How much are you saving? What is your age? And what kind of rate of return are you going to be getting from your investment? And then you also need to work backwards. We are going to talk about that when we discuss savings. I don't know how many people on the chat know about the rule of 72. The rule of 72 states that if you take your interest rate of return, divide it into 72, it gives you roughly how many years it will take your money to double. So let's say you are banking that the person who is saying, I would like to invest my money. Let's say for argument's sake, they are investing it with their bank. And we know, if we Google, we know the interest rate that we get at the bank. Let's say it's 1%. I don't want to say 0.05%. I just want to say 1%. So let's say the interest rate is 1%. If you divide it into 72, it will take you 72 years for your money to double. So how many 72-year periods do you have? So that's where we would educate them. It's not a wise idea unless you are working with an advisor who will put the numbers in the computer for you, show you factoring in your age, how much you are putting in, for how long. Do you have the discipline to continue making those consistent payments? Because if you sign a policy contract, you know, if I stop paying, it will lapse and I'll lose my money. So you have that, you make an effort to make sure that that policy doesn't last for 20 years, 25 years, whatever. But if it's your savings, you are managing it, are you going to be that disciplined? Are you going to find a good rate of return? And are you going to beat the taxes? Because RRSPs, they have limits. Tax-free savings is a limit. And then if you put it in a non-registered fund, where you'll be paying taxes based on capital gains and dividends, how are you going to beat that? So, and then if you, let's say you end up saving 150,000, your policy could have been having a face value of 500,000. So that, again, there's a discord. So it's a lot of factors to be considered before we can say, sure, this option of saving is better than the insurance. I hope that helped, but it's not an easy thing to just say, oh, I'll save my money, I'll find 7%, I'll find 10%. Are you going to find the 10%? Where are you going to put that money so that you beat the tax part? Because the tax part is huge. $500,000 tax-free. So where can you save that money without getting taxes? Because tax-free is limited. RSP is limited.
Like what I'm getting now is that the insurance gives you more than what the savings will provide at the end.